Coming up today, stocks finish higher on the back of a weak jobs report, an update on earnings, the latest moves in commodities, a look at the election polls, and what should us investors expect next week. It's going to be a good one, guys. Let's go. So we just finished the week out with a little bounce in the indices here. S&P 500 almost trading back to yesterday's highs before peeling back into the afternoon. Option dealers still pricing in some movement for next week. We've got the VIX 9-day at 23.4, still a bit above the VIX 30-day 21.8, and bond market volatility is elevated as well. Move index sitting at multi-month highs here, 132. And that's because once again, we got another rip up in US government bond yields. There's a 10-year, 438. What an absolute March high it's been ever since the Fed cut 50 basis points. We just got the jobs report in today. A lot weaker than economists had forecast, but that was to be expected due to hurricanes and strikes. Good news, unemployment rate still holding up at 4.1% and actually just reversed the SARM rule again, as unemployment has not continued to trend higher as was widely expected just a few months ago. And stick with me today. I'll share with you a swing trading idea later in this video, along with my fundamental and technical reasons behind the trade. And I can almost guarantee you it's something you've probably never traded yourself before and is currently sitting at a major support level. More on that later on. What was moving out there today? Amazon, after yesterday's really good earnings, coming in with a very solid beat, 25% above expectations. Gapped up today over 6%, now back into this resistance zone. And that's pretty much the all-time high price for Amazon. Like a lot of big tech stocks, been consolidating most of the year, some of them just sitting below their all-time highs. Apple fell a little bit though today after missing expectations. Didn't give the best details and guidance on the iPhone 16. Jury's still out on that one. And there's a look at Microsoft, just holding on to those lows from yesterday's massive gap down over 6%, even though they beat expectations. Same with Meta as well, just kind of stalling a little bit after yesterday's pretty heavy sell-off there. Having another bad day. Supermicro Computer off another 10.5% as we go into their earnings next week. After we had news back on Wednesday, their auditor, Ernst & Young, resigned. Really not a good sign. And Nvidia fell the day after as well, probably in sympathy with those other big mega cap tech earnings. Got a little bounce here today, up almost 2%, but doing the best today out of all the chip stocks. Intel, even though they missed on earnings yesterday, they gave much better than expected forward guidance, and the market seemed to really like that. One of the best performing stocks today, Proto Labs, are involved in 3D printing, up 38% on a really good earnings, way better than expected, very profitable as well, 47 cents in earnings per share. And this is another one of these high-flying stocks from 2020, 2021 that were knocked down really hard after they peaked going into 2022. But a lot of them have been bottoming out, showing signs of accumulation and approaching the top of their ranges, which is really interesting to see. And we've also been seeing some buying in the former high flyer 3D Systems. They're too having another good day ahead of its earnings next week. Still got some restaurant stocks moving out there as well. Papa John's slapping on 5.4% today. Portillo's as well, ahead of their earnings next week, up 7.3%. And a stock on my watch list, Sweet Green, up 5.3% today as well. But we've still got the Trump trade pulling back. DJT down another 13.5%, just lost its 50-day for the first time ever since his odds started improving. And this has coincided with his odds pulling back and betting markets, along with Harris's odds going up this week as well. And we're seeing some other assets associated with that trade pulling back the last few days as well. Bitcoin and American industrial manufacturing stocks as well, having a bit of a pullback here. And stick with me because later on, we'll talk about the China trade, Tiger Brokers, and what could potentially happen if Trump does win to the China trade. I'll give you my thoughts on that. But this is the most important event in financial markets for the here and now, right around the corner. Next Tuesday, US presidential election. Markets have been coiling up a bit going into this. Option dealers certainly have lifted their implied volatilities, pricing in the potential for some big movements in the market next week. And so just to give you an idea of what the expectations are out there, looking at numerous polls and betting markets, here's New York Times. Got Harris leading Trump 49% to 48%. The Economist got Harris beating Trump as well by 1.5%. Real Clear Politics pretty much got them neck and neck, evenly matched. And according to CNN, they too have got them both evenly matched here. With the Washington Post also got Harris out in front, 48%. However, looking at Interactive Brokers, Forecast Trader, as they too offer an election betting market, they got Trump out in front at 56% here. Another prediction market, Kalshi, got Trump out in front at 54%, but you can see that big closing of the gap over the last couple of days. And just looking at poly markets, still got a big difference there. Trump out at front, 59%, Kamala Harris, 40%. So pretty stark difference between the mainstream media's polls and betting markets. It'll be interesting to see which of them actually turns out to be right come this Tuesday. That is, if we actually get a winner on the night. We may get a repeat of 2020 and even the 2000 election, which they had to do a recount in Florida, take it to the Supreme Court. And this is the biggest risk for the markets. Markets typically don't like uncertainty. And this is what option dealers could actually be pricing in the most. Maybe if it is a really close race, comes down to the wire, could take a few days to do a proper count. And who knows, we may have another record amount of late mail-in votes. Just looking back in 2020, when we had the same kind of thing, the markets rallied up until the election. However, it only took the mainstream media about 3 or 4 days before they declared Biden as the winner. The Electoral College did it a bit later on in December. Market wasn't really too worried back then, as the consensus was Trump was going to lose anyway. However, it was a bit different in 2000. It took a little bit longer back then. They had the election in early November as usual. Weren't able to decide a winner. The market actually sold off all the way until mid-December, when they were officially able to declare George Bush Jr. the winner. However, this market was already on shaky ground after topping out in the tech bubble. But there's a look at where we are today. A little stretched coming into it. And so if we did get any political uncertainty, and a lot of markets have already priced in a Trump win, we could very well get some more volatility and a sharp sell-off. And so we shouldn't be surprised if that were to happen, and that would explain away the high VIX readings we've been seeing of late, even though the actual market's not moving around all that much. But looking back in history, at the day after the election on Wednesday, whatever direction markets move on that day, up or down, we can quite often see some follow-through on the subsequent 5, 10, and 22 days. For example, on the dollar. If the dollar were to move lower on Wednesday, 92% of the time it'll be lower 10 days later. S&P 500, same deal. If the S&P ripped up on Wednesday, we should expect that to carry through over the following weeks and months, especially in small caps. Maybe a bit of a fade the move in US treasuries. Same with oil, but a pretty good hit rate there for small caps and the dollar. And so amongst all this, we've been getting through the thick of Q3 earnings season. There's a quick bird's eye view at what we got yesterday. Pretty much same story all week. Beats across the board. SEA green. Similar story there today. Exxon and Chevron coming in better than expected. And just looking at an update today from FactSet, 75% of companies have reported EPS above estimates. It's equal to the 10-year average. And good news is the blended result from companies that have reported and estimated for companies that have yet to report. Earnings growth rate for the third quarter is 5.1% today, compared to 3.6% last week and 4.3% at the end of the third quarter. So we're actually doing a little bit better than expected here. And so the market doesn't really have a reason to sell off hard based on earnings or the economy. Political uncertainty, yes, but we just got the numbers in for asset performance in the month of October. We did actually finish down a little bit in US stocks. It's only really commodities, oil, gold, and the dollar that finished the month higher. And we had quite a bit of weakness in foreign markets as well, likely selling off as well in anticipation of a Trump win, along with the firming dollar and bond yields. These are all negatives for the here and now in foreign emerging markets. But Citigroup has taken a warming to small stocks, giving some reasons why they could be poised to outperform a low bar of earnings. So they may be hedged against risks related to a Trump presidency, and that's because Trump's proposed sweeping tariffs of 20% on all imports and tariffs of 60% or more on goods from China. That's pretty heavy stuff. Analysts said small caps have historically been hedged against tariff-related risks. And so again, that's why we've been talking about US domestic producers, US manufacturers, US industrials that don't really rely on China. They're not exposed to tariffs, and they could have the potential tailwind of new tax incentives and other regulatory tailwinds for producing at home in the States. Is that what a potentially new government is looking to drive? And so even though US economy did not create many jobs at all last month, in fact only 12,000, a lot weaker than what economists were expecting, 112,000. Fact is, the unemployment rate remained flat because a lot of these people were temporarily out of work. There's two different surveys for the non-farm payrolls and unemployment rate, and a lot of employers put their hiring on hold. So it was explained away by seasonal factors, and we can see that in this chart here. Amount of workers not at work because of bad weather spiking up, and we can see other signs that the jobs market is holding up. The average hourly earnings increased month over month, 0.4%. That was hotter than expected at 0.3% and has largely been in line with near the highs over the last couple of years. But regardless of all that, the way the market interpreted that was good news for the US economy because we've got bond yields, especially the longer durations, shooting up today pretty firmly here, along with the market's expectations of inflation. The spread, inflation protected treasuries versus regular treasuries, shooting up here, almost erasing nearly all of this pullback in the third quarter. And so we've got inflation expectations increasing while oil's been actually soft of late. What happens if oil shoots back up? What happens if this Iran and Israel thing really blows over and a new president may actually look to continue backing Israel in their war against Iran, and it may need to reach a bit of a blow off top before it's resolved? And there's a look at crude oil today, pulling back a little bit under $70 a barrel. A little bit of bearish seasonality over the next couple of weeks and month. But then when we're past that, there's a lot of bullish seasonality coming in December into the new year. And there's a look at the economic calendar for today. Non-farm payrolls coming in weaker than expected, but average hourly earnings better than expected. Same with the global manufacturing PMI. Manufacturing employment came in a bit soft though. And Fed fund futures haven't changed their tune either. Market's still expecting the Fed cut 25 basis points next Thursday. And so like I said before, we'll just take a look at the China trade. It's been pulling back here, coiling up. US presidential election on Tuesday. Chinese government holding a big meeting all of next week, in which it's widely expected they could come out with a big fiscal package potentially on Wednesday, the day after the election. Say they just want to know who's going to be in the White House as part of their strategy. Maybe they go a lot bigger if Trump wins to get in front of tariffs. They could hurt them more when they're down already. And so if we did get a Trump win, maybe China could sell off initially, but if they come out with a really big package, it's likely to shoot back up. And of course, tariffs will be negative for China initially. However, I think Trump's using them as a negotiation tactic. And I think reports of the fallout from them have been overblown, just like they were this time 8 years ago when they didn't cause a global recession, the US economy, or the Chinese economy to fall off a cliff either. So there is plenty of negative press out there about it. However, I think there's also the chance for a surprise on the upside for China and America to actually get along, work out a deal, not have a military conflict over Taiwan, and actually just get on with business as usual. No one's really expecting that. Seems to be a lot of dire forecasts out there. However, either way, we should expect a lot of volatility in the China trade, just like we should in a lot of markets over the next week or two, making our way through earnings. Got Tiger Brokers reporting in a week and a half. And like I said, I was buying the dip last week. And if we were to keep dipping down into the low fives or even fours again, I'll continue scooping up more shares down there. And also what I alluded to earlier in this video, a swing trading idea I've been looking at, potentially buying the dip on Monday's session, the SPDR FTSE International Government Inflation Protected Bond under ticker WIP. Now, a couple of reasons why I'm eyeing off this. For a potential swing trade, even hold it for a few months since it pays a monthly dividend at an annualized rate of 6.33%. Technically speaking, I can see we're stretched down here from the 50-day VWAP in this big double key support zone. Got some good bullish seasonality across the board. And fundamentally speaking, this is pulled back because of the strength in the dollar. So this is another way to hedge potentially a Harris win, because I think the dollar will pull back in that case. Not to mention, global central banks are on an easing cycle. They're trying to get their interest rates down. Well, inflation still hasn't gone away. So for inflation-protected bonds, the best thing you can have when owning them is interest rates continue coming down. As like all bonds, that'll make older bonds more valuable as they have come with a higher coupon. And with inflation-protected bonds, if inflation keeps going up, that's another tailwind. And so this is government bonds outside the States, countries all around the world, Germany, Spain, United Kingdom, Brazil, New Zealand. And so a pretty good dividend yield, 6.3% paid monthly. Technically looks stretched here, bit of a hedge if we do see a pullback in the dollar. And like I said, I may just hold on to it for longer than a swing trade back to the 50-day, because it's also a hedge on global inflation if commodities keep going higher. And central banks around the world are still trying to pull their rates down. And so that's why I'm a little bit interested in this as just another trade in my portfolio. As always, it's not financial advice. Please do your own research. I'm just sharing my opinion and thoughts with you guys, as I thought you'd find that interesting as well. Keep in mind, this is not really a liquid ETF either. Only averages 35,000 units a day, but still has 327 million assets under management, so it's not that tiny. Also, other notable movers out there today, utility sector coming off heavy, biggest losing sector down 2.2%, probably getting hurt by these higher yields as this competes with investor capital seeking yield, sitting at a bit of a key support zone here. Same with REITs as well, just took out some monthly lows, and Staples been pulling back. So the defensive trade has been pulling back, and just looking at the Vanguard Growth ETF, had a big pullback yesterday, but overall holding up a bit better than those defensive sectors. But overall, the stock market held up pretty well considering the sharp rise in bond yields of late and the dollar. That's normally a pretty strong headwind for the stock market. Like I said, option dealers got the VIX 9-day at 23.5, quite elevated, and is backwardation to the VIX. And just looking at my sector breadth table indicator, we are quite soft here up the front, except for health today, and a standout winner with stocks above their 50-day average. Financials also pretty good on long-term breadth there as well, with industrials, REITs, and utilities also holding up the best in the long term. Got quite a bit of softness here in energy and staples across the board. And there's a look at small caps as we go into next week, and the Dow Jones Industrial and the S&P 500 coiling up a little bit as we go into next week. So I'm going to stick with my forecast, even though I know it's a bit contrarian against the polls. I think if the states are able to decide a winner on the night, it'll be a landslide victory to Trump. He may flip a traditionally blue state or two, win most, if not all, of the swing states, and the stock market will be up 3% on Wednesday. Of course, I could be wrong. As you guys know, I'll be the first one to admit it. However, that's just my gut feeling from everything I've seen, all the data, and my feel for what's coming from on the ground in America, along with financial markets pricing, even though for sure we could see some more volatility on Monday and Tuesday going into it. Could be a good buy the dip opportunity. And like I said, there are ways to hedge it. What I'm looking at on Monday, international inflation protected bonds, and also a bet on Harris winning. There's another way this can all be hedged. Other than that, get your popcorn ready because next week could be a doozy. Thanks very much for sticking with Click Capital. Enjoy your weekend, and I'll see you again on Monday night. Cheers.